looks a little bit mixed. There's obviously some conflict in the market at the moment as to whether one wants to be concerned about demand erosion or one wants to be focused on supply shortages. There's enough for either glass half full, glass half empty, and I think the tug of war is clear. Let's kick off with Clyde Russell, Asia Commodities and Energy columnist, Thomson Reuters. Clyde, just starting with your column overnight on the Saudis' record price for Asia shows the Russian war impact is your headline. Ultimately, I think a record OSP from Saudi Arabia. What's your analysis on that?
Well, I think the OSPs the formulas are fairly consistent in how it actually is applied. They look at a whole range of things, time spreads, refinery profits, and things like that. But what the underlying message of this is that there is the Saudis and indeed other Middle East producers seem to be expecting quite a large demand call for their oil come May, because we're talking about May loading cargoes here. So they feel that they can raise the prices. Refinery profits have been very strong. I imagine a $9.35 premium for Arab Light is going to knock the hell out of refinery profits in Asia come May. But at the moment, they're saying strong demand for their oil. And I think that's because a lot of refiners in Asia are sort of stepping back from buying some of the Eastern Russian grades, Espo and Sokol and Sakhalin. And, they're sort of thinking, well, we'll try to get hold of more of the Middle Eastern grades. So that's where I see that pressure sort of at the moment.
And Clyde, do you think Asian refiners will take it on a chin, such a big margin when there is discounted Russian oil available?
Well, certain Asian refiners are going to go for the discounted Russian oil. We've already seen quite a lot of buying from Indian refiners. India has been very careful not to condemn Russia's invasion of Ukraine. They're still playing nice. You would expect that if assuming they can organize the finance, that Chinese independent refiners will go will be still keen to buy Russian Espo grades and things like that. These buyers will take the discounts very, very easily. I think it's more your sort of Japan, South Korea, Taiwan, Singapore, even those refiners might balk at buying Russian cargoes. Certainly, there was quite a lot of Russian crude that used to flow, particularly to Japan and South Korea, and I would expect that sort of flow is under pressure. On the other hand, I also think that Asian refiners are really going to be, the Middle East grades will become the grades of last resort. So they'll buy them if they have to, but they're now going to be scouring the globe for cheaper crude. We still see in the physical market, and I'm sure Kieran will have more to say on that, but my understanding from talking to people is that there's still quite a lot of West African grades available for May, and things like that. So I think you're going to find that Asian refiners might be trying to minimize the amount they buy from the Middle East, but ultimately they might have no choice. And I think that's what the OSP rising to a record level is. The Saudis are thinking they've got no choice. And we'll see if that actually is the case come, when we start to see what's being delivered in May.
Let's welcome Ali Al-Riyami, consultant and former Director General of Marketing at the Oman Ministry of Energy and Minerals. Ali, do you expect that the other Gulf oil producers will follow Saudi lead with these very large OSPs?
Well, actually, good morning, first of all, Sean and everybody.
Good morning.
I think this is historically that, most of these producing countries in the region, they are normally waiting to see what is the prices of Saudi oil, and they follow the suit. So I won't be surprised to see also the others, except Oman, because our crude is very transparent, and also it is traded in the market in a different way. But most of these countries, I think they will start, acting according to what Saudi Arabia has done yesterday. But this is a very surprise to all of us. I mean, everybody was talking about a price war in the coming days and coming months between Saudi oil and Russia to the same market. But this shows you now that the demand of Asian producers like Saudi Arabia and others, it's superior than the Russia for very good reasons, and everybody knows the reasons. But this shows you that I don't think we will see a kind of a competition between the grades and also between the producers in the coming few months.
Let's welcome Kieran Gallagher, Regional Product Director at Vitol Bahrain. Kieran, welcome to the podcast for the first time. The big part of this narrative, Kieran, of course, is where is diesel given its it's very elevated prices, the shortages that are appearing, the dislocations. How do you see diesel's role and where its market will go vis-a-vis the Russian disruption, if you like?
Yeah, good morning, Sean. Good morning, Clyde, Ali. It's obviously a very interesting one with diesel. I do think we'll see a change of flows over time. Maybe that's started already. But we came into this Russian-Ukraine conflict in an already very tight middle distillate market. So the move on diesel has been exacerbated somewhat because of the sheer volume of exports that Russia gives to the European market in particular. I think at the moment, obviously, much of Western Europe is still taking Russian oil. Yes, there's some self-sanctioning going on, and therefore the real impact hasn't hit yet. It's also offset somewhat by the current situation in China, where we very much are seeing stock building and obviously lower demand because of the current COVID situation. So I think there's an argument to say, well, we haven't seen the full impact of this yet. I think we're continuing to see across the world gas to oil switching and therefore very, very healthy diesel demand in non-traditional sectors. So how do I see it playing out? I think there is going to be a change of flows that Russian oil could point to different areas. But as Clyde pointed to on the crude front, the buyers for the Russian material might be Asian buyers. A lot of the Indian refiners are already net exporters of diesel, so they're not markets that this flow can traditionally go to. Perhaps Latin America, perhaps a little bit of West Africa, etc. But certainly we see problematic future on the diesel front for if this continues.
And Kieran, if we take the obviously all of these things are about timing, right? We're into the second quarter now. The Russian disruption, as you highlight, hasn't really happened yet, right? The export 5 million barrels of crude a day, 2 million barrels of product. Everything was pretty much on schedule for month of March. As we go into the second quarter, the end of winter, the start of the driving season, if you like, vis-a-vis the US high demand, time of year, how does that play in, do you think, where that collides with the Russian disruption?
Well, I think we're seeing, particularly in Europe and North America at the moment, a massive fight for yield in the refining system. And I think that's been exacerbated this week a lot between jet fuel and gas oil. Jet fuel in New York Harbor hit $320 a barrel this week, which is absolutely record for a physical barge trade. And therefore, you see it already where jet fuel production has suffered at the hands of the need for diesel. Then, as you say, we're moving into driving season, particularly in the US, where that need for gasoline is there, and that will indeed eat into diesel production. So I think we're going to see a real fight for yield continuing, perhaps in the US more than other countries.
Clyde, is the oil market never mind under pricing the scale of potential disruption coming out of Russia in the second quarter, but are they overpricing the scale of demand destruction in China in the second quarter, this battle? But looking at the China demand destruction, how do you see it going forward? How big do you think it could actually be?
Oh, that's a big question. It's very hard to put a handle on that.
It just feels like it'll be more than people are currently pricing.
I guess it all depends how long China continues to lock down major cities or major centers like Shanghai. Certainly, I was talking to someone there today. They've been locked down for more than 20 days, and there's no end in sight. It's a sort of an ongoing lockdown. Will that create some demand destruction? Absolutely. The question is, what happens when it finishes? Do the Chinese hit the accelerator hard? In which case they'll be, spending a lot of stimulus on things like construction, things that tend to be quite diesel heavy. So, that's if you look at it this way, you might have demand destruction right now, followed by a surge in demand later. What happens during this period of demand destruction right now is interesting. It's not a given that China will start exporting larger quantities of diesel. Everything has to be approved through the permit system and things like that. So the Chinese government kind of controls that flow more than they would in a free market economy. So I'm not certain that we will see a large amount of product exports out of China, but I recognize that it is a possibility for this month and for May. And then I expect that once they get over their current COVID battles, then they will have to accelerate their economy quite strongly. And that will be very positive for both crude import demand and probably from products as well, because they won't be exporting as much.
Ali, the big question of the last few weeks inevitably and continues to be, why doesn't OPEC Plus pump more oil? And ultimately the answer is, I think, and often because they can't. But my question to you is more about, obviously May is predetermined and it's been baked in the agreement for some months now. Oman is one of the few countries it would appear that actually has been able to increase its production, and secondary sources indicating to go above 1 million barrels this year, from 900 and something to 1 million and something, which in percentage terms, of course, is big enough. But my question is really about September, Ali. It strikes me that we're starting to see signs, a bit like a Formula One race meeting, where on the Saturday everybody goes out to see how fast they can drive to get to the front of the track or the pole or whatever it's called, because everybody's testing their full capacity, because come September all bets are off. Your thoughts about as we move over the next few months ahead of that September end of the current OPEC Plus agreement?
Well, actually, I have no doubt that most of these OPEC Plus countries, again, they don't really, I think they have the capacity, technical capacity to grow their production, including a big, neighboring countries. Otherwise, they could have, increased their production a few months ago. But I think there will be a race. I know that because normally the problem is, don't forget, Sean, that most of these countries, they have delayed their projects in the upstream. So this is the impact again of delaying the project 2 years ago and 3 years ago. This is again shows you that this impact it is showing there today. So I think most of the time we will be seeing some countries coming back, but very, very slowly. And I don't think they will be able to increase their production to their capacities. That is my view. Regarding Oman, don't forget that the condensate is out of the oil, crude oil. So we have quite a few extra production from the condensate because of gas and because of other fields. That's why we see some increase in the total export production. Production, and the export is increased because of that. So now we have a link of both, crude oil and condensate, and that's why we have extra production. Sorry, is there any technical issue here?
I'm hearing a few little burps, but nothing major. Kieran, coming back to the emerging, as we've just sort of highlighted in our first comments round, is the idea that this dislocation, the flow disruption, is going to start to trickle through. We're seeing reports out of Kenya where there is logistics disruption to middle distillates. We're seeing also the World Bank forecasting that there could be economic slowdown. How do you think the dislocation from flow, where does Europe get its middle distillates if it stops taking Russian diesel starts getting disrupted? Where do you think that disruption comes into play most profoundly? Obviously, Africa would feel the heat of a lot of this.
Well, I think the east coast of Africa and indeed South Africa are currently feeling a few repercussions from government intervention from the initial supply shock, and therefore, where there was duty rebates to importers, etc. And there, I think in the case of Kenya, those duty rebates aren't getting paid immediately, and therefore the next round of imports, the importers are struggling. And therefore, you're getting queues at the pumps. Small independent retailers actually can't afford to import, and they become wholesalers. So there's some knock-on effects from these duty rebates. I think just in the last 48 hours, South Africa have also announced a new system of rebating duty to importers, and that's also going to cause some speed bumps with regard to supply down to the wholesalers. So there's that element. Separately, the second part of your question, where does it feed in from Europe? I think what we did see 3 weeks ago was a massively open arbitrage from the Middle East to Europe. So if you take the let's say regional demand of say diesel per se out of it on the East, Middle East, Pakistan, etc., like that, and you say, well, there's roughly 3 million tons a month there to go east or west. And we've seen at the beginning of this year, perhaps just over 1 million tons of that AG and Indian diesel going east. Around 3 weeks ago, there was an open arb. The east-west was minus $160 a ton. Everything pointed west. And indeed, you could argue that whatever 2.5 million tons of that excess flow can go to Europe. So Europe can get covered here. I think that's one thing.
If they're willing to pay the premium that Asia has always paid.
Exactly, Sean. That's exactly it. And therefore, it's the actual premium that is going to this is going to be reflected in. And then you've got effectively two different pricing centers pooling for the same oil, and that's currently been reflected in the FOB premium that you're seeing paid for diesel in the Middle East at the moment, where a 10 ppm cargo is trading north of $7 a barrel versus a term price for 2022 around $1.50.
Clyde, you guys in Australia must be feeling a bit like the Gulf Arabs right now. Everybody must be rich, driving Maseratis. Everything you can dig out of the ground there seems to be at a record high price. Is Australia booming?
Well, that's an interesting question, because everything is at a record high price, including diesel. And, I have stopped driving my SUV and started driving my teenager's little runaround because it uses half the fuel. And, so if someone relatively well off like me is feeling that pain, then, you can bet that a lot of Australians who are not direct owners of the natural resources are feeling pain. So for the wider public, they feel the pain of inflation and high fuel prices, and not really so much the pleasure of the high prices for everything else. That said, Australia is going to be making absolute tons of money. And, it's not really an oil story, it's more an LNG and a coal story. And even, iron ore has not responded massively to the Russia thing. I still think that's coming, because Russia is a major supplier of steel to the world, and that's going to disappear. Well, not disappear, it's going to be redirected and disrupted. So there's tremendous opportunities for virtually every commodity that Australia makes, that it competes with Russia. So yes, overall the country's going to do well, the government's going to do well, but the individuals are suffering.
When we take that point mentioned earlier, that there'll be some countries, refining sectors in Asia that will take in this heavily discounted Russian oil and versus those that won't. How do you think that impacts the market and the likes of Australia or others who may comply and abstain but end up having the higher price point, that disruption to like typically China would be exporting products into Asia, India as well?
It's kind of interesting. I think the stories and pictures coming out of Ukraine are so horrendous that people, in a country like Australia, may well be prepared to put up with a bit of higher prices if they feel that this is actually going to help bring an end to the conflict. I think there's all sorts of interesting side issues that we haven't really started to explore. Australia is down to effectively 2 operating refineries. They import a lot of products now. So if we are importing from China, who's to say that diesel we're buying from China wasn't made with Russian crude? So, are we going to have to start monitoring, what refinery we're purchasing products from to make sure that they're not processing Russian crude? Same goes for India. And other product exporters that we rely upon? Or are we going to switch our product slate that we're only going to buy from refineries that we can so-called trust, like those in Japan and South Korea that also export? So I think, these are what I would term second stage disruptions. We've still really to see the first stage disruptions of how much Russian crude is actually lost to the global market, how much product is lost to the global market. That again is maybe even a second half of April, but May onward story. And then you've got these secondary things of, well, will I buy product if I think the refiner has used Russian crude to make it? That might be an issue for Indian refiners. Who knows?
It's a bit like how is there carbon in your aluminium production? We can't buy carbon over a certain level. Ali, I wanted to get your thoughts on the regional outlook here now with Ramadan and the ceasefire in Yemen in particular, the idea that there is a moment of opportunity for the region to find maybe a new path forward. At the same token, the Iran nuclear talks are not yet quite over the finish line. Will they get there? Your thoughts on the impact, particularly of the ceasefire in Yemen and the maybe Iran nuclear talks?
Well, it's all good news, Sean. We hope that they will manage within these few coming months to get at least an agreement on Yemen, crisis. Regarding the Iran nuclear deal, I think the Iranians were very clear at the last statement saying that we will not go to Vienna unless we are going to sign an agreement. So that shows you that the agreement was already there, but it is ready to be signed. But unfortunately, unforeseen circumstances appears the last few weeks to stop the signature. So, but I think overall it's all good news. I hope and I wish and I pray that the Yemen crisis is getting to the end, and I wish also the meetings in Jeddah will see some good results, which is I think everybody is having a good faith now and needs to get together and agrees on agreements.
Let's go to the survey question this morning. Fairly simple idea. We've seen Brent crude oil will likely stay in the 100-110 a barrel for April as expectations bed in for no conflict in the Middle East during the Muslim fasting month of Ramadan, which could have been the extra layer to sort of break out of. It seems like the Ukraine war in its current state and all of the pieces of it has us in this 100 to 110 up and down the ladder on Brent. Will we stay there for the month of April? That's the question. Agree or disagree? Kieran, of course, as an integral part of the physical distribution of these crude and products in the world, Vitol and all of its peer group are in the center of that. How difficult is it, I mean, just to address the point that Clyde just made there, I mean, there might be Russian oil inside my diesel or inside my whatever. For you and your peer group, how much of a burden is this on you to be the policeman, or do you abstain from that position and whatever's legal is legal, whatever isn't? How do you navigate that?
No, I don't think you can abstain. I think there's a huge amount of dialogue going on, whether it be with governments, with our receiving customers, with our suppliers, etc., like that. Our compliance team are intricate in this dialogue as well. So no, at every sort of facet of our business, because this conversation is part of every product trade at the moment, Sean. There's no getting away from it, and it could be, as Clyde alluded to, maybe a Japan to Australia trade. But there is contractual wording with regard to sanctions clauses, etc., that come into to these deals now, just so that everyone is on the one page. So no, there's dialogue, as I said, at every facet of the business, and we just have to devote that time as we really are doing.
And is this a period? I mean, obviously, the nature of your business and the nature of this space is that there's always something, right? We've had Iran sanctions, Venezuela, there's wars, there's all sorts of reasons why this is a complicated space. Is this much more profound than others, would you say, from that point of view?
You would say it is, because just the sheer volume of energy exports that Russia currently supplies to the world. So yes, with Iran it was more localized and largely crude going to refiners, etc., like that. With Venezuela as well, it was largely based around the Gulf Coast market and the US. So no, this has a much broader impact for sure.
And when you take that point, I mean, vis-a-vis the kind of ripples on this challenge is the insurance premiums associated with Russian waters and shipping, and then the Black Sea having, it would be reported, mines potentially and so forth. That sort of physical disruption and obviously the price vis-a-vis insurance, is that a structural challenge that has yet to play out in this equation as well?
Again, I think it plays out in the actual delivered price of the oil, etc., like that. I think in the early stages of the conflict, when there was such uncertainty around this, we were seeing some ship owners quote up to $200,000 for the war risk to enter the Black Sea. It didn't matter if it was going to a Russian port or any other port. It was just to go into that Black Sea. I think that's stabilized somewhat now, but what we are seeing, as you alluded to there, is a sort of ever decreasing fleet of owners of physical vessels willing to call to Black Sea ports.
The situation going forward, Clyde, we talked a little bit in our conversation there, crept in the idea that this Asia versus Europe thing, in terms of the price competitiveness, as in the medium term, as Europe maybe aggressively seeks other supply that would otherwise go to Asia. Is that a narrative that's bedding in at all in Asia? Do you see it, this sort of competition going forward, LNG and everything else?
I think certainly it's very much a narrative in the LNG and coal markets, because we can already see that happening. It's not so much that Asian LNG, like from Australia and Indonesia and Malaysia, is flowing to Europe. It's just they're taking everybody else's LNG. So the US LNG that used to come to Asia is now going to Europe. And, the sort of Qatari cargoes that were available for spot transactions, they're going to Europe and not coming to Asia. So we already can see that. I don't think people have quite really understood how it might impact on crude markets and product markets. I think what we actually end up seeing, if coal and LNG were any guide, is the rich countries in Asia, so your Japans, Koreas, Australia, they'll compete with Europe because they can. And your poor countries in Asia, or your poorer countries in Asia, your Pakistans, Bangladesh, India, and some of the other developing countries like the Philippines, they're going to struggle. And the solution for them is unfortunately things like demand destruction start to come into play. So in a way, the way I see this turning out is a rich versus poor, and it doesn't really matter whether you're poor in Asia, poor in Africa, or poor in Central America. You're probably the ones who are going to get squeezed.
Just to conclude a little bit, Clyde, one last question for you on that, the China question again. I know you obviously signaled quite early last year that China was going to have a decline in its imports in 21, and you were obviously proved correct. Would you make a call on that this year yet? A second year of declines?
No, I think we've kind of reached the point where China's probably going to be steady, maybe even increasing. It all really depends on new refining units. So as they commission more refineries, their base moves up. What I've seriously think has stopped is their extra sort of 1 million barrels a day that they were storing. I think their strategic storage is probably close to full or at a level that they are comfortable with. So what we see now is that their import demand is really going to be much more closely aligned with the refinery throughput, and rather than that extra million barrels a day that we've been the market has been enjoying, if you can put it that way, for several years, that's sort of disappearing out.
Let's get the survey result and give Ali the last word this morning. Agree that we're caught in this sort of price point on crude 100 to 110. In some ways, Ali, that feels like, given everything that's going on that we've talked about for the last half an hour, that's a reasonable price given the scale of possible disruption, conflict on the border of the world's two biggest oil exporters.
Well, actually, everybody was trying to bring the price down with the release of 160 million. It didn't really work out to be the right decision, and we still see the prices, above 100 and 105 WTI, and also 110 almost Brent. So I think the price above 100 for the coming few months, this will be the norm. And I don't see any reasons the price could go down, except if there is another extra release and the crisis in Ukraine and Russia will escalate. That's the only way I can see that maybe the price will try to reduce. Or the agreement with Iran will be signed soon. Then we can see some barrels from Iran to the market. But rather than that, I think this 105 to 110 price will continue.
Well, certainly you would think in the short term. I would be a little bit concerned about where America goes over the course of the year vis-a-vis a Fed tightening strategy that looks like it's set to unleash a few significant increases in rate rises over the coming months, which may slow down the US economy and US demand, but we will have to wait and see. We need to wrap it up there. Our half hour is done together. Kieran Gallagher, thank you so much for joining the podcast. Hopefully you'll become a monthly regular. It'll be nice to have you back. Clyde, as always, great to have your voice from Australia. Ali from Muscat, thank you so much. Have a great day, everybody. We'll catch up soon. All the best.